$4,227 an ounce today. That's not a price, that's a warning. If you think this is just another upswing, you're already a step behind. This is how major shifts begin, quietly, then all at once. And here's the part most people skip over. Central banks have been adding gold at levels we haven't seen in decades, roughly 1,000 tons a year, 3 years straight. In recent interviews, Jamie Dimon outlined scenarios where gold could run far higher. Ray Dalio linked owning gold to understanding long-term cycles. Ken Griffin noted investors drifting toward gold when trust in currency weakens. Sit with that for a second. Preference over fiat. Logged. Now here's where it turns dangerous. Because what unfolded around December 1st, most people missed it entirely. The Federal Reserve ended quantitative tightening. They stopped pulling liquidity out of the system. And on December 10th, reports point to another rate cut. That isn't a routine tweak. That marks a shift, because while they were battling inflation, the labor market absorbed the damage. Roughly 32,000 private sector jobs disappeared in a single month, the sharpest decline in more than 2.5 years. Small firms shutting down, wages stalling, consumer demand rolling over. And the Fed? They see it. John Williams of the New York Fed recently noted they have room to ease. My translation, underlying concern, verified. I'm not a financial advisor. This is not financial advice. This is straight analysis from public data. Now here's what gold is actually signaling. Because this isn't a price jump. This is what I call a fracture of trust. Watch this. The dollar index slipped below 100, a psychological cliff. In 1999, the dollar represented about 71% of global reserves. Today, roughly 58.4%. The dollar is losing share. And where is capital moving? Gold. Physical gold. Kazakhstan has been accumulating record amounts. Brazil made its first purchase in 4 years. Poland is reportedly aiming for 30% of reserves in gold. 30%. These aren't casual buys. These are strategic positions. And here's the part that should stop you. Analysts now note that, for the first time since 1996, central banks collectively hold more value in gold than in U.S. Treasuries. More gold than U.S. debt exposure. That isn't a shift. That's a quiet upheaval. Undeniable. But hold on. Because this pattern has surfaced before, 3 separate times in modern history, and every time, the people who ignored it paid the price. 1933. America underwater, banks failing, unemployment near 25%. Roosevelt takes an extraordinary step, Executive Order 6102. Mandatory surrender of gold at about $20 an ounce. Refusal carried consequences. Once the government controlled the supply, they revalued it near $35, about a 40% devaluation overnight. Citizens lost purchasing power. Authority tightened its grip. Gold became the reset mechanism. And the public paid. Check. August 15, 1971. Vietnam draining U.S. finances. France sends a warship to claim its gold. A warship. Confidence fracturing. Nixon goes on national television and ends the gold standard. One announcement. Bretton Woods collapses. And what happens next? Gold accelerates from roughly $35 to more than $800 by 1980, a move that tracks every major rupture in the economy. Inflation cuts through households, oil shocks ripple across markets, stagflation settles in, and the dollar loses footing. But gold becomes the instrument people trust. Those who anticipated it stayed insulated. Those who didn't were exposed. Verified. 2008 arrives and the script repeats. Lehman disappears overnight. Bear Stearns collapses. AIG is propped up with taxpayer funds, and the Federal Reserve injects trillions into the system, not metaphorically but directly. Gold climbs from the $700 range to nearly $1,900. Why? Because people recognize a basic principle. When governments expand the money supply, gold tends to retain value. When confidence fades, gold tends to outlast. When financial structures realign, gold historically becomes the bridge. December 5, 2025. Same pattern, different decade. U.S. debt surpasses $36 trillion, and around $20 trillion of it matures within 10 years, which leaves only 2 paths: repay it or roll it forward. Repayment isn't realistic, so extension becomes the option. But that's where the trap appears. Rates climbed from near 0 to around 5% in roughly 18 months. and servicing costs are now consuming an enormous share of the federal budget. It's becoming a numerical constraint, in my view, and the Federal Reserve appears aware of that pressure. That's why rate cuts enter the conversation. Not because the economy is outperforming, but because the debt structure is tightening around policy choices. If they don't cut, the system absorbs severe strain. If they do cut, inflation may return. Either path carries risk. And gold responds. Gold always responds. Undeniable. Now here's where the danger escalates, because the issue extends far beyond the dollar. The IMF's chief economist recently stated that the global framework that has operated for 80 years is undergoing fundamental restructuring. Restructuring, not adjusting, not refining, restructuring. The old rules are fracturing, the new rules aren't fully articulated, and in that open gap, uncertainty grows. Nations are positioning for it. China reportedly hasn't released updated gold reserve data in years. Russia is said to have reduced treasury holdings while expanding gold positions. Saudi Arabia signs oil agreements in yuan, and the petrodollar system built since 1974 shows signs of fatigue. And when that system weakens, in my interpretation, gold reemerges as the shared reference point because institutional trust erodes, while gold carries 5,000 years of reliability. Check. Let's shift for 30 seconds. The chart is signaling something as well. Gold has attempted to break above 4,250 several times, stalled, and retreated toward the 4,164 range, where support held cleanly. Now it's tightening, moving sideways, coiling the way it often does before a decisive move. If it slips below roughly 4,085, a deeper pullback is possible, but if it breaks through 4,250, several technical analysts point to 5,000 as the next logical target. And beyond that level, resistance thins out. No defined ceiling, just momentum and crowd psychology. Because once the question shifts from, is this too high, to how high can it go, the curve can steepen quickly. Undeniable. Now look at this. Most people are ignoring a critical signal. Silver recently touched $57, nearly $59 this week, up about 97% this year. Why does that matter? Because silver in many ways tracks gold's behavior, and when it begins outperforming gold, that signal deserves attention. It points to two forces, in my view. First, industrial demand is reportedly accelerating. Second, investors appear to be rotating into hard assets broadly, not just gold, but anything tangible, as confidence in paper-based instruments softens. Verified. The World Gold Council released new projections. Pay attention here. They outline scenarios where gold could advance another 15 to 30% in 2026, placing it somewhere between roughly 4,800 and 5,500 under conservative assumptions. But they also explore far more aggressive cases: heightened geopolitical tension, persistently negative real yields, accelerated central bank accumulation. In those models, some estimate 6,000. Others propose 10,000. A few mention 15,000. And analysts who specialize in historical revaluation patterns discuss numbers like 38,000, even 138,000. Impossible? Not if you understand the theoretical revaluation framework. Here's the mechanism. The U.S. government's official valuation of gold sits around $4,220 an ounce, a figure unchanged since 1973, even though the market now trades near $4,200. Now imagine a hypothetical scenario where gold is revalued to help stabilize a $36 trillion national debt. Divide $36 trillion by roughly 8,000 tons of gold, and you arrive at a theoretical price near $138,000 per ounce. But here's the question analysts raise. How much of that gold has been independently verified in recent decades? The last comprehensive audit of Fort Knox was reportedly in 1953, 70-plus years ago. The full inventory has not been publicly confirmed since. And if a crisis ever forced a revaluation, hypothetically, and gold was needed to restore confidence, the resulting price could move in unpredictable ways. Check. Now let's address what you might be thinking, because I know the reaction. $10,000 gold? That's exaggerated. But history shows a pattern. Every major move looked unreasonable before it happened. In 1971, people dismissed the idea of $100. In 2008, they dismissed $1,000. In 2020, they dismissed $2,000. And now at 4,200, skepticism remains. Yet the ones who positioned early, they're not doubting. They're prepared because they grasped something essential. Gold doesn't surge primarily due to speculation. It rises because of fear. Fear of inflation, fear of geopolitical tension, fear of structural failure, fear of uncertainty. And right now, all four forces are arguably active at the same time. Undeniable. So, what follows next? Here's one plausible sequence in my view. December 10th, the Federal Reserve may cut rates by 25 basis points. Gold could rally, potentially pushing through 4,250. Momentum may accelerate into early 2026. If gold breaks that level, a test of 5,000 becomes possible. And beyond that point, momentum becomes difficult to map. But here's the nuance. This cut may not mark the start of a long easing cycle. It appears more like a tactical adjustment. The Fed is attempting to balance two competing pressures, supporting the labor market without reigniting inflation, and doing both simultaneously is extremely difficult. Cut too aggressively, inflation can reappear. Cut too cautiously, unemployment may spike. Either path historically favors gold, because in stagflationary conditions, gold is one of the few assets that can hedge both sides. It hedges inflation. It hedges contraction. That's why central banks are reportedly accumulating. That's why some billionaires are repositioning. That's why everyday savers are finally paying attention. Verified. And the conversation isn't confined to traditional financial outlets anymore. It's on X, Reddit, everywhere. People are calling this the trust shock. Some argue that gold at 4,200 isn't just an investment. It's a signal of currency stress. Central banks appear attentive to it. That's the message. And the crypto community is drawing parallels to Bitcoin, suggesting that a surge in gold can indicate capital rotating out of fiat, first into gold, then potentially into Bitcoin. Some commentators even project Bitcoin toward 1 million in the distant future, framing it as the final stage of a broader wealth reset. Whether one agrees or not, the central point remains the same. The narrative has shifted from, is gold a good investment, to, is the system under pressure? And when narratives shift like that, the crowd often follows. Check. But here's what mainstream coverage rarely emphasizes. This isn't only about gains, it's about protecting what exists. Because if the dollar loses another 20% of purchasing power, your savings lose 20%, your paycheck loses 20%, your retirement loses 20%, unless you hedged strategically. And the hedge that has endured for 5,000 years is gold. Not stocks alone, not bonds alone, not real estate alone, gold. Because gold carries no counterparty demands. It isn't anchored to a government promise. It doesn't rely on quarterly earnings or balance sheet projections. It simply exists. And in a world where almost everything feels unstable, that kind of permanence holds value. Undeniable. So here's my perspective. If you're waiting for absolute confirmation, you may already be late by the time the reset becomes visible to everyone. Gold could be at 8,000, 10,000, or simply beyond reach. Institutional money reportedly isn't waiting. Central banks aren't waiting. Billionaires aren't waiting. So why would anyone assume time is unlimited? But here's the part people forget. There's opportunity here, not just risk. Every major reset in history produced winners and losers. In 1933, those positioned in gold were compensated. In 1971, early accumulators multiplied their wealth. In 2008, hedged investors survived the downturn. And in 2025, the same framework may be emerging again. But this time, you have the data. You have the pattern. You have the indicators flashing. So the real question isn't, will this happen? The real question is, how will you respond? Because the Federal Reserve's warning, in my interpretation, isn't verbal. It's structural. They ended quantitative tightening. They're cutting rates. They're signaling sensitivity in the system. And gold reacts in the only way it can, by rising, by breaking new highs, by reflecting underlying pressure. So here's what I suggest you consider, not as advice, but as education. First, understand the landscape. This isn't about chasing fast gains. It's about protecting what you've built. Second, study the history. Learn the cycles. Understand why gold behaves the way it does. Third, think about positioning thoughtfully. No need for extremes, but some level of exposure, whether physical gold, ETFs, or mining equities, can place you inside the trend rather than outside it. Because standing completely on the sidelines right now, in my view, may be the riskiest position of all. And if you want insight not only into what is happening, but what may unfold next, subscribe. because this is just the opening chapter. The next video walks through how a potential global reset could develop, the timeline, the triggers, the assets that tend to endure, and the ones that historically do not. You don't want to miss it. Hit subscribe, enable notifications, and get ready, because the world appears to be shifting. And those who recognize it early often end up the ones who thrive. Gold just crossed $4,200. That isn't just a number, that's a signal. The question is, are you listening?